Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to look at the EIA show. We're going to look at some different key pieces, and we're going to break it into our normal 3 shows. But in the first one, we want to talk about Israel Gaza impact to flows, and the U.S. But we're going to start high level and then really kind of drill down how this could impact, or if it has impacted the U.S. to date, and what do we expect going forward. Then we're going to shift in segment 2 to the issues that we see in the distillate storage side, how that is more of a structural problem than it is anything else. And then in segment 3, we want to look at how Israel Gaza and the other issues, or I should say wars or conflicts, are continuing to impact crude flows. And if OPEC Plus is going to cut more volumes, could there be an embargo? If so, how, what would that really do to the market in general? So getting right into it, we want to really jump to what is happening on a global basis. So when you look at total oil product stocks, the surplus narrowed from 24.2 to 15. So again, we're moving in the typical trend. If you look at the market in general and look at those gray lines, the cloud, you can see it kind of tightens up. You have those extremes coming down. So again, there's really not much to say one way or the other in terms of the positioning. Total crude stocks land in floating, flipped to deficit from plus 0.8 to a negative 6.8. A lot of that is driven based on land storage, because floating storage still remains elevated, and we want to talk about some of the nuances within that. But then on the total oil product stockpiles, surplus narrowed from 23.4 to 21.8. So it's important when you look at that, because it's not being driven by distillate. It's being driven by gasoline. Gasoline, fuel oil are significantly above average, but distillate is very much below average. So it's going to become a bigger issue when you start looking at refiners, because refiners, when you make distillate, you inherently make gasoline. So the question is, well, if I'm making diesel and then I'm inherently making gasoline, well, where do I put the gasoline? Because we're not seeing the same amount of demand. And as you can see, we're butting up against making new seasonally adjusted highs on a global basis. And I think that's important because everyone likes to kind of narrow in on just the US, but you have to look at abroad. There's a significant amount, or a record-setting amount really in Europe. There's a significant amount of gasoline in Singapore. And we want to piece all those things together. All the while, Nigerian crude sales have stalled. When you look at the sales that have sputtered, it's actually putting some pressure on what's to come, not only just in November, but also December. And a lot of it is driven by high freight rates, steep backwardation, weak refining margins. And realistically, you're going to have to see some of these physical prices come down to try to incentivize some of those moves. And that's going to create an overhang on the unsold levels in November, and that'll put pressure on December when we look at West Africa, but more specifically Nigeria, because Europe's been buying a decent amount of Angolan crude that's being left in the market by China. And those are some of the key pieces right now. Like we've heard Iran talk about the need for an oil embargo. And the question is, well, is this going to be similar to the 1973 embargo? And it's really not. And the reason why is because the U.S. is producing much more crude than before. We're not relying on imports to the same way, which is also another reason why we don't need the SPR to be the same way. When you look at Canadian production, when you look at U.S. production, you put those together, we're still exporting 4.3 million barrels a day. If that changes, we will still have to import more heavy sour, medium grades. But when you look at Brazil, when you look at Mexico, when you look at the U.S., when you look at Canada, there's volumes available. And then it's for those that know me or follow me on Twitter, or some of the clients that I've spoken to, they've said to me, as Israel Gaza increases, what do you expect? And I said, expect us to start talking to Venezuela again, because if you look at Venezuelan crude grades and Iranian crude grades, they can be swapped. And that was the whole thing, where if we're looking to replace some of these Iranian cargoes or try to move somewhere else to ensure there's enough flow, Venezuela would be the likely spot. And there's about 500,000 barrels that can come fairly quickly if we get a changing in sanctions. So here's the land storage we were talking about. Deficit narrowed from negative 38.7 to negative 32.9. You can see it's just bumping along that low level. It's still, again, starting to bounce back up. But you can see the rate of change of the drop was extensive. It normally declines and then starts to build here, but you can see that we're starting at a much lower point. And a lot of that is driven by west of Suez. Deficit narrowed from 32.5 to 24.5. And then east of Suez had a widen from 6.2 to 8.4. But again, that's just looking at Japan. There's still a significant amount in China, which we'll talk about more in segment 3. Total floating storage, the surplus narrowed from 11.3 to 9.3. Then in the next 3 slides after this, we're going to show you how that has changed a bit. West of Suez, the surplus widened from 0.5 to 4.3. And then east of Suez, the surplus narrowed from 10.2 to 4.8. We expect west of Suez to bounce higher again, and then east of Suez to move back up. Not out taking over 2022 levels, but we're going to see some of that start to bounce a bit higher. And even though when we start looking at the different flows, crude oil on the water still remains very elevated, continues to move higher. That's something that we see happening in general. When we look at crude oil in transit, still staying at seasonally adjusted all-time highs, and really the highest level that we've seen going back to May. And that's just because there's been a renewed push of crude into the market, not only from floating storage, but also some newer sales as you get some of the latency when you look at Russia and you look at some of the other flows. Now, when we look at crude oil and floating storage, you can see we're still staying at that low level, but we do see some of that creeping higher just because oil that goes into transit comes out of floating storage. And then there's, depending on the timing delay, you'll see it go from transit back into floating storage, which is why we do see a bit more coming into the Asian markets as well as the West African market, which we'll talk a bit more about in segment 3. Now, when we look at the supply adjustment, starting to bounce a bit higher, but that's typical when you start looking at kind of towards the end of the month. The export data is monthly. You have some of these monthly flows, which is going to be a bit problematic when you look at some of the intra-month data. Then when we turn to crude stocks, you could see that there was a draw of 4.49 million. Small build in pad 1, but everywhere else had draws. Biggest draw coming from pad 3 and pad 5. Pad 3 was a big draw because, again, we have seen some sizable exports that has, we had a big build last week. But again, there's always that balancing act because that big build was really not fully real. Just like the bigger draw is, you kind of have to look at these together just based on the swings that we're having, given the amount of exports that we've seen, as well as the timing on imports. So pad 3, pad 5, 2 areas, especially pad 3 with their import-export side. Pad 5 very heavily weighted towards the import market, so there's timing on that. But it's interesting when you look at the crude oil production sitting here based on EIA at 13.2 million. That's something that is well above what our expectations were. We had an exit rate initially at 12.7, 12.8. Then we thought it was actually going to come down. But we're seeing more production on the lighter end, so how much of this is crude, how much of this is condensate can be up for debate. But when you look at the flows in general, there's still a significant amount of production that exists in the U.S., and there are ways to kind of edge that higher if we need to, in case there is some sort of embargo, in case there is some sort of unified front on an OPEC side. We've seen some flows increase from Saudi. There's definitely a cash shortfall at this point, and they currently have about 5.5 to 6 million barrels off the market, not just Saudi, but across the whole landscape. So it's unlikely that you'll see them willing to do more, and those are things that we also want to cover when we talk about tomorrow in the Econ show and how that's shifting. And because there's been talk back to 1973, obviously oil production and oil demand, you have to look at demand. Demand is obviously higher than it was at different points in time, but you can see that we are well above where we were in 1973 when you look at the production side. We were about 9.7 million barrels a day, and here we're at 13.2. So you still have a little bit of that gap available. We do have terminal decline in some parts of the Gulf of Mexico, especially when you look at the Mexico itself, but some of that has been replaced with new production coming out of Canada. Those are things that are very much needed in the Gulf of Mexico, which is again why having that Keystone XL would be helpful, in terms of bringing that additional crude into the Gulf, into Pad 3. When you look at total crude inventories, you can see that we actually normally have this little dip at this point in time. And it's usually right around here, just because this is where we start getting into kind of that peak, the trough in terms of refining activity. You start to see some draws from products, and you start to get some of this balancing act. And then you start to see some of those builds increase. So we will get a build next week. The question is going to be the rate of change of that build. And that's always going to be paramount when you look at how are we setting up going into, the end of shoulder season and really launching into the winter months. So then when we start looking at total oil and products, you can see that we're still above where we were in 22. And we're tracking pretty close to where we were in 21. And you can see in 21, 2018, you have this little dip that typically kind of happens. You had it in in those last few years. And then you kind of get a little bit of an increase, and then you have a bit of a flat line. We do see that being very similar at this point in time. But again, the rate of change is going to be the key driver. Excuse me. When you look at crude oil in Pad 3, you can see that we're still at the third highest we've ever been, with 2020 and 2022 being higher, but 2022 only by a small margin. So we're still fairly comfortable in Pad 3, even though, again, it's all going to be a matter of what are exports doing, what are imports doing. We do see exports remaining robust at this point in time. Cushing continues to fall. We thought it was going to start to pivot a bit higher, similar to what we saw in 2022, but instead it's kind of flatlined here. We do expect this to kind of pivot at some point. Because Cushing isn't as important as it has been in the past, when you look at pipelines that have, essentially bypassed Cushing going straight to the Gulf Coast, you don't have the same level of importance. Not to say it should be ignored, but again, it's not the same level that is needed as we've seen in previous years. And then when we look at runs, here you can see that there was a small increase of 0.4. A lot of that was driven by Pad 3. In general, when you look at the 5-year average, it looks like it's a bit higher. But then when you look at the average for the U.S. in general, you can see we're firmly in what is, let's call it average. We should see a continuous flat line here with some ebbs and flows, maybe up 0.5, down 0.25. But again, we're going to live in this world. And then as we get towards the end of October, you start to see that pivot up, and then you start to see those increases back to about 93, 94% utilization rates as we get into those core winter months, which is going to be important given how low we are on the distillate side and the lack of ability to pull it from the floating market. So imports were down 386,000 barrels. So it shouldn't be a surprise given the draw in Pad 5 to see that Pad 5 had a huge drop in imports. It was down 545,000 barrels a day. That's 400,000 below the 5-year, 175,000 below the year-on-year. So again, that'll change. That's all a timing issue. So that's why when we say you're getting a little bit more noise because of this. Pad 3 is a bit firmer on the import side, but they had a sizable export number. And then Pad 2 continues to be a big draw for imports, which we don't see adjusting. Pad 3 gives you an idea of kind of how low it is. We were expecting to be a bit closer to the 5-year average, but you can see there's normally a dip, then a recovery. We do see that recovery or that bounce, but we're not going above the 5-year average. We're going to continue to be in this level. And then when you look at Pad 2 is hitting the new seasonally adjusted high. Again, it's going to stay above the 5-year average. Given our needs for heavier crude, we're going to see this remain the case. When we look at implied demand, gasoline continues to trend back towards the average, which is what we were guiding towards. Remember, this is looking at the buying from rack to retail. And remember, you've had gasoline prices come down considerably, and there was a big holdout waiting for some of these price adjustments. So there's a little bit of a makeup number in this. We don't believe we're actually at 8.9. We think we're closer to about 8.7, which is, again, still better than 8.58, which we never thought was a real number. It was kind of a trough. And then we start to see this normalize, and then we'll likely settle at about that 8.7 million barrel a day number. Distillate, same thing. There was a big holdout because of pricing. So this is a bit of a makeup number. We do see this dropping considerably. It's 348,000 barrels a day over the 5-year. Distillate fuel oil, the demand came in at 746,000 barrels a day. That's much higher than it actually is. We will see that drop. It'll likely come back to about 4.1 because there is still some backfilling that needs to be done given the delays in buying. And then the same can be said when you look at propane. Propylene going from 587 to 1.49, so an increase of 906,000 barrels a day, well above the 5-year average. We've had a fairly wet harvest, which means that you have to do a lot of drying. The drying of the harvest is powered by propane dryers, so that it's not surprising to see that big bump. We had a little bit of cool weather come through. It gets a bit warmer, but then it drops off again as we get into the end of October, November. So again, that's also going to be weather related as we get towards the end of this month. This is just looking at the U.S. gasoline implied demand. We're still below that 10-year average, but working towards it. And it's important to look at seasonality. We typically get the bounce. We had it in 22. We've had it pretty much every year where you start to get that bounce back up. You start to see that normalization. Guys are getting rid of their summer grade. Fully now buying winter grade. Starting to get that balancing act, which is happening here. So that's why we're saying we see it leveling off, still below the 10-year average, but closer to an 8.7 million barrel a day number. Days of supply still fairly comfortable. Again, this is kind of showing that there isn't a huge risk at this point in time. Which is why you hear the terms about an embargo. Some sort of pressure. It's not going to carry the same weight as it has in previous years. Not to say it's not going to, increase inflation or keep inflation where, stable and moving higher, but you're getting an idea of kind of where we sit, especially given the amount of gasoline in the market. It will create a bigger issue for distillate just because there's a big distillate problem. But at this point in time, it would be a bigger hit to some of our allies abroad, and especially in Asia and other versus here. But at the same time, when you look at 73 and now, we are way more intertwined into the economics, the economies, the military presence versus 73. So it's unlikely to see the same level, especially given they had just taken over or repossessed, if you will, Chevron assets or Standard Oil assets. So we don't have the same backdrop as we had in the past. Not to say it wouldn't, if, based on the rhetoric, we're up, $1, $2. There's probably $5 to $7 of geopolitical risk currently in the Brent market. So, and then Iran saying these things is just going to keep that kind of front and center and keep a certain amount of concern in the market. Gasoline storage, it's still well above where it has been, but this is what we were saying. Now it's starting to follow some of those moves down. Imports have increased a bit. They'll likely slow back down just because freight rates are back up, so it's still going to be at the higher level. And then as demand kind of cools and you get some of this balancing act, because remember, some of the retail side was holding off. This is going to create some backfill. So once that's kind of done, we do see this staying at a very elevated level and start bouncing more to sideways. Distillate continuing to move lower. We're not in a good position. All of this is really being driven by Pad 1, which unfortunately is where we consume the most amount of fuel oil or heating oil, which is why if we have a normal or cold winter, there's going to be a lot of problems in the region. Jet fuel, grinding a bit higher. It's just going to be that balancing act. When we look at the curve, you can see that the steep backwardation still remains in play. A lot of that is driven based on increase in insurance, freight rates. But one of the things that we've been very consistent about is the importance this means for the back end of the curve. We've been saying longer dated crude was a better bet here. that continues to play out instead of trying to guess on some of the front month moves. And then when you look at floating storage in the U.S., it's come down a bit. We do see that increasing slightly, but still staying at the lower end of that bucket. So that's what we have for you on the EIA side. In the next segment, we're going to go deeper into U.S. demand and the kind of the structure heading into the key demand season for distillate and how problematic this is going to be. Not only now, but we have to find ways to address this going forward because there is a structural issue.